Welcome to the Wealth Blueprint. Today we have a very special guest, and we are jumping right into a deep dive on a pretty shocking reality.
Yeah, thanks for having me. It's a reality most people don't want to face.
Right. And the reality is this. The harder you work for a traditional paycheck, the more the government legally penalizes you.
Exactly. I mean, it's literally built into the math.
So we're unpacking a guide called the Wealth Blueprint today, and I want you, the listener, to do something right now. Picture your last paycheck.
Just think about the gap between the gross and the net.
Yes. You look at the gross income, the money you supposedly earn, and then you see the actual dollars that hit your bank account. There is this massive chunk missing.
It's brutal. State taxes, federal taxes, FICA.
Right, FICA, which is the mandatory payroll tax for Social Security and Medicare. We usually just, shrug it off. We think it's just your fair share.
But you shouldn't shrug it off, because the core premise we're looking at today is that the traditional W-2 paycheck is legally the most heavily taxed income stream in America, period.
Which is wild, because we are taught that climbing the corporate ladder and getting a bigger salary is the goal.
Well, it's the goal if you want to be trapped in the income tax trap. Look, W-2 salary earners pay the highest taxes in the country, while the ultra-wealthy are paying close to zero.
Okay, let's unpack this, because that sounds like a rigged game. If you're on the corporate treadmill, every time you work harder and get a raise, the government basically just cranks up the incline.
That is a perfect way to look at it.
You run faster, but you're sweating out like 40 to 50% of your energy before you even get a drink of water.
Right, and to understand the mechanics of that treadmill, we have to look at how different types of income are classified. So, active versus passive income.
Okay, break that down for us.
Sure. So when you're an employee, you are trading your literal time for a salary. That is active income. You have to actively be there.
Right. If I stop working, the money stops.
Exactly. You have zero leverage. But worse, the government taxes active income at the absolute highest marginal rates. You could easily lose half your money depending on your state.
And it comes out immediately. The government basically stands at the front of the line with a bucket.
Yes, the order of operations is what kills you. As a W-2 employee, you are taxed before you even see a dime. Your employer legally has to send the government's cut first.
So you have to survive on the leftovers.
Exactly. You fund your entire existence on the crumbs. But let's look at the parallel universe of the business owner. What's fascinating here is that the tax code isn't actually a book of punishments.
Wait, really? Because it definitely feels like a punishment.
I get that. But it's actually a book of incentives. It outlines exactly what the government wants you to do.
No.
And for business owners, the order of operations is completely inverted.
How so?
A business earns revenue. Then it spends that revenue on operations, equipment, travel, vehicles. And then it only pays taxes on the profit left over.
Wow. So the business gets paid first, spends money on its needs, and the government is the one waiting at the back of the line.
Precisely. The business eats first, the government gets the crumbs.
But come on, when we see billionaires paying zero in taxes, people assume it's, shady offshore accounts or illegal loopholes.
It's not a loophole and it's not corruption.
Yeah.
It is strict compliance. They're just following the incentives.
What kind of incentives?
Well, the government relies on the private sector for things they can't do themselves, like housing. The federal government isn't building apartment complexes, right?
Right, they need private developers for that.
Exactly. So they offer massive tax incentives. If you take your capital and build housing, they will legally reduce your tax bill to zero.
Okay, I want to dig into that. How do they actually get to zero? The source material talks heavily about real estate and ghost expenses.
Yeah, specifically a mechanism called depreciation.
Right. And without getting bogged down in boring accounting jargon, what is depreciation in the real world?
Think of it as a legal on-paper loss. The IRS assumes that any physical building is slowly degrading. The roof, the plumbing, it's all aging.
Okay, sure. Things break down.
So they let you write off a massive portion of the building's value against your income every year. It's a ghost expense. You didn't actually spend that cash, but the IRS lets you claim you took a loss.
Wait, if the building is demonstrably going up in value in the real world, how does the IRS logically allow you to claim a ghost expense and say it's losing value?
Because they separate the physical structure from the market value. Yes, the land and the market demand are making the property more valuable, but the physical roof is degrading.
Ah, okay. I see.
The government wants landlords to keep cash reserves so the buildings don't collapse. So they give you this huge paper loss.
So on your tax return, you look completely broke. You're showing these massive losses.
Exactly. You look broke to the IRS, but in reality, your bank account is flooded with rent checks from your tenants.
And because of those ghost expenses.
The paper losses cancel out the rental income. You collect that cash flow completely tax-free. It's passive income. No FICA, no payroll taxes.
That is insane. The W-2 worker loses 40% right off the top just for showing up, and the asset owner shields all their cash flow legally.
Completely legally.
Ugh.
And looking broke on paper while actually hoarding wealth leads us to the ultimate elite strategy.
Here's where it gets really interesting, because the blueprint calls this the buy, borrow, die playbook.
Yeah, it's the institutional playbook for generational wealth.
Let's break it down fast. Step one is buy.
Right. Buy scarce appreciating assets. Real estate, index funds, private equity, things that grow without your active labor.
Okay, so I buy assets. They grow to, say, $10 million. Now I want to buy a luxury yacht or a mansion. Normally, I'd sell some assets to get the cash right.
But if you sell, you trigger capital gains tax. You lose hundreds of thousands of dollars. The ultra wealthy never sell. That brings us to step two, borrow.
Borrowing against your own money.
Exactly. You go to a bank, use your $10 million portfolio as collateral, and borrow $2 million in cash.
Because, and this is a massive point, debt is not taxable income.
It is not. The IRS views it as a liability, not income. So you get $2 million in tax-free cash to buy your yacht.
But wait, we are conditioned from childhood to view debt as a trap or a failure. You're taking on massive bank loans. Doesn't the interest eat you alive?
Not at this level. Debt is an arbitrage tool here. Your interest rate on a collateralized loan is maybe 4 or 5%.
Okay.
But your $10 million asset portfolio is growing at maybe 8 or 10% a year.
Wow. So the asset growth outpaces the interest on the loan.
Exactly. You are literally getting richer while living entirely off tax-free borrowed money.
You're using debt as a protective shield against taxes. It completely flips the script on how we handle money.
It does. But eventually you pass away, which is step 3, die.
Right. You can't live forever. But if you die with a $2 million loan, doesn't the bank take your assets and trigger all the taxes anyway?
No, because of a specific mechanism in the tax code called the step-up in basis.
Break that down for us, because that sounds super technical.
Sure. Let's say you bought that portfolio for $1 million and it grew to $10 million over your life.
Okay, so $9 million in profit.
When you die and leave it to your heirs, the IRS resets the purchase price, the basis to the market value, on the day you died.
Wait, so the IRS acts like my kids bought it today for $10 million.
Yes.
So the $9 million of profit just disappears from the tax ledger.
It is entirely wiped clean. No capital gains tax is owed on that historical growth.
That is staggering. So how did the kids pay off the yacht loan?
They just sell $2 million of the newly inherited tax-free assets, pay off the bank, and keep the remaining $8 million tax-free.
It's a closed loop.
If we connect this to the bigger picture, this is why you cannot just rely on your labor. W-2 workers have a third of their life energy confiscated, while asset holders run this perfectly legal wealth machine.
So hearing all this, it's honestly pretty overwhelming. If you're a standard employee listening right now, you can't just walk into a bank and demand a multi-million-dollar asset loan.
No, of course not.
So how do you actually start playing by these rules today?
You have to change your structural classification. You don't have to quit your job, but you need to start an LLC, a freelance practice, a side business.
So I just opened up a second classification for myself.
Exactly. The moment you have an LLC, you change your order of operations. Let's use a quick example. Say you need a new $2,000 laptop.
Okay, I go buy one at the store.
If you're a W-2 employee, you buy it with leftover dollars. You probably had to earn $3,000 in gross salary just to net the $2,000 after taxes.
Right, it cost me $3,000 of effort to get a $2,000 laptop.
Exactly. Now imagine you have a side consulting LLC. You earn $2,000 in revenue, and you buy that exact same laptop as a business expense.
Because it's a tool for the business.
Right. You write it off pre-tax. You only had to earn $2,000 to buy a $2,000 machine. You legally bypass the tax penalty.
So what does this all mean? It sounds like the goal isn't necessarily to quit your day job tomorrow, but to legally split your identity.
That is the exact first step.
You open up the second bucket, so you stop being just the fuel that runs the machine and start owning a piece of it. But I imagine you can't just blow those tax savings on vacation.
No, absolutely not. The money you shield from taxes in that business bucket must be funneled directly into assets.
Assets like real estate, or index funds,
Or REITs, real estate investment trusts. They let you own fractions of commercial real estate without buying the whole building.
Right. The whole point is to aggressively convert your labor into passive income.
Exactly. If you don't funnel that money into assets, you are actively choosing to stay on the treadmill forever.
It really is a complete perspective shift. True financial security isn't found in a high salary. A high salary just makes you a larger target. It's built through a diversified shield of assets that the government legally protects.
This raises an important question, though. A real macroeconomic thought experiment for everyone listening.
Let's hear it.
If the entire tax system is mechanically designed to penalize wage earners and infinitely reward asset owners who leverage debt, what happens to the economy when the middle class universally wakes up to this reality?
Oh, wow.
Right.
Wow.
What happens when everyone simply stops aspiring to be employees and demands to be an asset holder? Who is left to actually run the treadmill?
That is a phenomenal, terrifying question to end on. Definitely something to mull over the next time you open that envelope and stare at your pay stub. Stop running blindly on the treadmill and start building your own blueprint. Thank you for joining us on this deep dive. We'll catch you next time.